Welcome to the monthly 3-Edge View from the Edge for June 2023. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and I'm joined here once again today by Eric Biegeleisen, Director of Investment Research, Deputy Chief Investment Officer here at 3-Edge Asset Management. And today, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary 3-Edge research model. Before we begin, a brief recap of the activity in the global capital markets. And on Thursday evening of this past week, the U.S. Senate passed the debt ceiling legislation before the June 5th deadline, thereby avoiding a first ever U.S. debt default. Meanwhile, a report on Friday showed that the U.S. economy created 339,000 jobs in May, which was much higher than consensus, which came in at 185,000 jobs. And the report highlighted the continued strength in the job market despite rising interest rates and heightened recession fears. The report may also throw a bit of cold water on investor expectations for the Fed to pause and not raise short-term interest rates during the FOMC meeting in mid-June. And then yet another economic report, the Institute of Supply Management, reported that U.S. manufacturing industry is shrinking and at a faster rate than the prior month of April. Meanwhile, in May, the uneasy and relatively narrow rally in U.S. equities continued. Talk of the potentially transformative nature of artificial intelligence, its capacity to supercharge the global economy, has kicked into high gear the shares of a handful of technology companies. However, the recent excitement over AI is beginning to sound a bit like the exuberance among investors in the late 1990s during the now infamous era of the dot-com bubble. The nature of the advance in U.S. equities, which is basically that you have a small number of stocks driving overall gains, that's not often a longer-term bullish indicator for future equity market returns. So, with those recent market developments as a backdrop, let me bring in Eric, and let's take a look to begin at our global asset matrix and the chart, which will show, importantly, the most important thing maybe is how things may have changed since the prior month. So I'll turn things over to you, Eric.
Great. Thanks, Fritz. Yeah, we can see the updates here to the View from the Edge asset class matrix. A few notable changes here. We have Europe moving down 2 spots. It had been this positive 1 spot, now moving to the negative 1 spot. And we'll get into the details, something we've been talking about for some months, though that had been our one attractive asset class in the equity markets. We also see developed Asia, specifically Japan, moving up a spot, though still in a mixed outlook. And commodities taking a downtick as well, down to -1. But we'll probably unpack these and others as we move forward.
All right, great. So now, as we do, we'll dig into the major asset classes and we'll look at the detail. And let's begin with equities and the U.S. equity market.
Yeah, well, as you mentioned in May, the narrow rally in U.S. equities continued, and thanks in large part to the handful of tech companies that you alluded to. We have to talk about NVIDIA, right, being the prime example, who announced that their chips will be the center point for future generative AI transformation that's underway. And this sent the stock soaring, and it made it $1 trillion firm, actually. And just to put, though, in perspective from a valuation standpoint, its price to sales ratio is now in the high 30s. It's around 37 or 38. It's never been this high before. Let's compare that to the NASDAQ 100, which is an index of 100 generally tech-focused companies. That has a price-to-sales ratio around 4.4, and its highest ever is around 5.7. Okay, so that just so you see where NVIDIA is, and that's all still well north of the S&P 500, which is currently sitting around 2.3. That's actually looking pretty cheap by comparison. But that 2.3 on the S&P. This is the most overvalued decile of price-to-sales ratios for the S&P going back 150 years. So everything's really overvalued here. The concentration of these tech stocks, it's been driving the positive performance, while the overwhelming majority of the other stocks in the index are neutral or down on the year. So as you mentioned, this is not historically a recipe for continued positive performance. Meanwhile, the Federal Reserve is still working to contain inflation. That remains higher than it has been since the 1970s. And the debate around the upcoming FOMC meeting in mid-June seems to be either between, another 25 basis point hike or, a so-called hawkish pause, right, with this potential indication of a future increases in the meeting ahead. So, beyond the significant overvaluation of U.S. equities, we still have an inverted U.S. Treasury yield curve by the way we measure it. That is short-term interest rates higher than long-term interest rates, and that's weighing negatively on the overall outlook. The lagged impact of the tighter financial conditions brought about by the restrictive Federal Reserve monetary policy over the prior year, that may just be starting to play out. So for us, all these factors taken together, keeps the outlook for U.S. equities cautious. Yeah.
All right, great. So let's shift our attention to European equities, which, as you showed in the matrix, have now declined in terms of their attractiveness, but they still have outperformed the U.S. equity markets year to date. So what is our model saying now? We've seen them shift down in terms of attractiveness. What are the factors contributing to that here?
Yeah, it's been the shining star for much of 2023 from our model research standpoint, ranking it as the most attractive equity asset class that we model. And year to date, European and specifically German equities have outperformed the S&P 500. They're up about 13% through the end of May compared with the U.S. At around 10%, just under 10%. However, and we've been mentioning this potential caution with European equities for the past couple months, the lags in certain factors in the model that we've noted as a negative, they've caught up now in the present. And specifically, I'm talking about the yield curve measure for the region. It's gone from flat to inverted by our measure, meaning that the short-term yields are higher than long-term yields. I sound like a broken record, which is the signal of potential economic weakness ahead. And this negative is now more than offsetting the positive contribution from the reductions that we've seen in inflation in the region, which had really been positively contributing to that outlook. So inflation remains a bit elevated in the region. It may prove stickier in Europe than in the US, and it may require further rate hikes by the ECB in the months ahead. So the outlook has shifted down to a less positive footing as a result.
Excellent. Okay, so now we'll shift our attention to the Japanese equity market, which has had some pretty nice gains so far this year, and where the model is indicating, well, at least it's less negative than it was.
Yeah, I think that's right. Yeah, Japanese equities, they pretty much kept pace with the S&P 500 year to date, though on a currency hedge basis are way ahead, as the Bank of Japan, that is Japan's central bank, has been one of the few major central banks to continue with stimulative monetary policy, potentially responsible for the weakening of the yen. Our model research is now a bit more positively disposed towards this asset class, which rose in May and benefited from this positive investor psychology and positive momentum. That said, the Japanese yield curve measure that we calculate, it is still a leading negative factor, though possibly less negative as we look in the months ahead, kind of the opposite of what we had been seeing in Europe. And so as a result, we are moving Japanese equities up to that more mixed outlook, but potentially becoming more positive in the future.
Excellent. All right, so let's shift gears now into the world of fixed income and the bond market. And let's look at the current interest rate environment first, which would be the U.S. Treasury market. And, obviously there was volatility in that market based on the angst among investors about the debt ceiling, which as of a couple of days, we've now put behind us. But what is the model saying about the outlook for interest rates in U.S. Treasury market?
Yeah, well, as you mentioned, it appears we will avoid a debt default with this bipartisan bill passing through the House and Senate, though they've simply kicked the can down the road for 2 years rather than fixing the issue altogether. So I'm sure we'll be talking about this issue soon enough.
But I was really concerned that they were going to kick the can down the road for 6 months
That's
or
right.
something
That's right.
like that, which really would have been awful.
We'll
So
take the W where we can, I suppose.
take it. Yeah, I agree.
As for the upcoming Federal Reserve meeting, investors have been really wishy-washy as you look at the Fed fund futures market between a hike or a pause or a potential hike in July. So recent comments are maybe indicating more a pause is maybe more likely on the table, but one never knows until the meeting is underway. Either way, we have witnessed yields on U.S. Treasuries moving higher, sort of across the board, as is the case in much of the rest of the world. The U.S. Treasury curve, it remains inverted, and therefore we continue to favor short-term U.S. Treasury instruments like floating rate notes, T-bills, and short-term TIPS, Treasury inflation protected securities.
Excellent. So let's take a look at the corporate bond market or the credit markets. And oftentimes there we're looking at credit spreads. So what is the model indicating there?
Yeah, the model research remains quite cautious of corporate credit markets. We've said that for quite some time. In the US, we're seeing the inverted yield curve, widening investment grade and high yield credit spreads, and a widening TED spread. That is the difference between the interbank rate and the Treasury bill rate, all of which taken together do not inspire confidence for the outlook for credit. The leverage loan and high yield debt walls, that is the maturity walls, start to really increase in 2024 and then really ramp up from there in the years ahead, which will lay additional challenges for companies seeking to borrow and refinance their debts at these higher interest rate levels.
Did you call it the debt wall?
The debt wall.
I like it. It sounds ominous. So.
It does sound ominous.
Anyway, moving on. So let's take a look now at real assets. So that would be gold and commodities, beginning with gold, which gave back some of the year-to-date gains during the month of May, but still solidly positive year-to-date. So what is the model saying now about the outlook for gold?
Yeah, the current long-term outlook remains positive towards gold. We still believe that in the long run, gold could serve as this, better hedge than bonds against a potential downturn in the equity markets. That said, currently the model research indicates that gold could face some headwinds in the shorter term, specifically if the Federal Reserve needs to continue to increase rates to combat the elevated inflation here at home. We could see real rates, that is nominal less inflation rates, we could see those rise, and that would potentially weigh negatively on gold in the shorter term. But in the longer term, should the Fed be forced to revert to a more stimulative policy, maybe inject liquidity back into the financial system, that could weaken the value of the US dollar, which would likely be a good thing for the value of gold. Another positive for gold stems from many of the world's major central banks continuing to be buyers of gold bullion to distance themselves from reliance on the US dollar as the world's reserve currency. And then finally, and we've noted this for some time, holding some gold can hedge the risk associated with the heightened geopolitical tensions that we're seeing globally. And it seems to be no shortage of those. So, the outlook's a little more cautious in the short term, but still bullish longer term.
Excellent. Okay, and then we'll shift gears from gold, staying in real asset gold, to commodities. We have seen the price of oil, I believe, continue to decline here in the month of May. But what is the model telling us about the outlook for commodities now?
Yeah, the outlook for commodities is looking somewhat negative. With global growth outlook slowing, as we really talked about, it's indicated by most of the yield curve measures we calculate for the major equity asset classes, particularly China, being inverted. The outlook for commodities just is not particularly favorable currently. Commodity demand could be at risk in the face of all this lagged impact from the monetary tightening by the world's major central banks just starting to kick in. And then, just shifting to a more specific area, we've talked about Russia's war with Ukraine and the concern regarding the scarcity of agricultural commodities. And this area is this is being shifted to more of a mixed outlook as well.
All right, great. All right, well, Eric, thank you. Thank you very much for providing the update on our outlook for the global capital markets. Eric and I will be back again in early July with the next monthly edition of View from the Edge. Meanwhile, Steve Cucchiaro and I will be back next week with the next edition of the 3 Edge Week in Review. And if you would like a hard copy of our full View from the Edge newsletter for June, you'll find that on our website, and that is 3edgeam.com. And as a reminder, our entire video library is always available on our 3 Edge YouTube channel. So, on behalf of Eric and everyone here at 3 Edge, thanks for listening.